All right, so thanks for submitting your GVA. I will be going through that on the last lesson, which is next week, because I think it will be important for your finals, even though I know your finals will be quite much later, right? Maybe in May or even, yeah, should be May or even June. So yeah, you can take some notes from there. Just want to quickly do a quick poll. Is everyone feeling all right with this course? Is it very heavy? Do you think the content is tough? How's everyone doing so far for this course? So I know most of you are like year three, right? Year 2, year 3. So maybe it's you're quite used to all the heavy load from each course so far. Not so good, very heavy. Okay, very tough. So this course, I guess, as of most courses, if you realize SUSS is that it's quite heavy. Even like because I teach the other financial management course in year 1, that is actually very heavy too. This course, the thing is, it actually follows the CFA level 3. So actually, if you are interested in take CFA level 3, you kind of have the knowledge on portfolio management. Of course, they'll test you more than that. So if you notice, a lot of the things are following CFA. And hence level 3, of course, is the toughest, right? Because CFA is level 1, level 2, level 3. So you have to, and it takes 3 years to actually do it. So you need to do level 1 in 1 year, level 2 in 2nd year, and level 3 in the 3rd year. So they expect, basically when you're at CFA level 3, they expect you, first of all, to be a practitioner in the industry, meaning that you have a lot of like knowledge about finance already. And that's why you notice that a lot of the things, they can't assume that you know what's like, what's a bond, how it works, all the different kind of bonds, etc., or even like derivative, those are covered actually in CFA level 2. So yeah, that I guess that's a bit of the difficulty. And also, I think even your finals, you'll notice that, the passing rate is very low for CFA level 3. It's like 30%, or I think level 3, yeah, it's around 30%. Maybe level 1 is like 35%. Yeah, it's quite tough. And the thing is, the assessment that like, for example, TNA, right? Assessment, I think they follow the CFA format in a sense, right? If you notice, like even the questions on ethics. So a lot of people feel the CFA because of ethics, and CFA are very strict about ethics. So for example, like even for my marking, I was quite lenient in the sense, like if you do give like an alternative answer, that's fine. But in CFA, they're very strict. So if like you don't identify the right ethics, you immediately get the answer wrong. And if you notice, like, I'm sorry, I'm not referring too well, but if you notice, like even the TMA, the ethics component is like 40%, and like per line is like 10 marks, right? So it's quite big. So yeah, so that's a bit tough. Nevertheless, this lecture and the next lecture will be a bit lighter. Okay, so this lecture will be slightly lighter. If you notice, it's not as heavy, not even the number of slides is not too many. And the last lecture will be actually quite light, especially given that it will be covering on ESG. I think most of you all probably have some kind of knowledge of ESG. So it's just more to formalize the knowledge. And after that, yeah, not be too difficult. All right, okay, so you know what? Let's kickstart the discussion today. See that more and more people are coming in. All right, so I just want to kickstart the chapter today by first going through what we have covered already, right, in this quick portfolio management process. Okay, so we first of all, remember we did the IPS, and then we talked about this thing about all the unique things that we have to talk about, the time horizon, tax, liquidity, etc., risk and return. So we talked about this in lecture 1. I want to highlight that a lot of the times, right, if you look at cases, you might think that it's very free form, right? Free form meaning like, oh, you can just write whatever you want, whatever like knowledge that you have, or whatever that you have heard or seen. But I want to just caution you that when you write IPS or when you answer a case, right, try to fall back on the frameworks that was being taught in class, right? To ensure that you capture all the marks. Because in terms of like even the marking scheme, right, they'll follow closely to the kind of like structure that was being taught, in the sense like, for example, I think in the TMA we mentioned that, you know, when we talk about risk tolerance, we need to talk about willingness and ability, right? So those are covered. So try to follow the structure. Right. Okay, so we have covered that on lecture 1. Lecture 2, we have talked about more like the strategic asset allocation, or how do we allocate asset. We talk about like all the various assets that we have. You know, we have bonds, we have stocks, alternatives. We talk about REITs. We talk about, you know, various things about assets, right? And then we also try to understand the modern portfolio theory, how it works. So today we will talk about the modern portfolio theory again for a short bit, if you notice later in the slides. Lecture 3, we talk about more the market, right? So like, how do we form market expectation? We think and because the market expectation basically will drive our investment strategy, right? The next, so this last lecture actually, we just talk about rebalancing, right? So rebalancing, you know, how should you tilt your portfolio? You know, we talk about this thing called equity style. If you can't remember, we had like value stocks and growth stocks, right? Those are like equity styles that it's kind of that we might have. Of course, we talk about a lot of other things as well for rebalancing. So we are actually on the last step already, but we are discussing performance evaluation today. So as I mentioned, next lecture is just about ESG. So it's basically away from the portfolio management process already. So we are basically, this lecture, we are done with portfolio management process. And in performance evaluation, I want to quickly give you just a very broad overview and intuition, is that there are 2 levels that we need to look at. First of all, we need to look at the fund sponsor level, right? And then the managerial level. Manager meaning the portfolio manager. So we are very familiar with the managerial level. So portfolio manager, you know, how do you assess them? Almost like as if like a KPI. You know, if you are some of you are working, almost like a KPI, right? How do you assess your KPI, etc. So those are a bit familiar, right, to some people. Then at a fund sponsor level, we will look at, because of in a portfolio, right? How do you get the money? How do you get assets? First of all, there must be sponsors for the portfolio, or the company that manages the portfolio. So those sponsors are like fund sponsors, and we also have to assess how the fund sponsor can allocate the funds accordingly. Because of course they will allocate the funds to, like, let's say I want how much in agriculture sector, I want how much in manufacturing. So after they allocate, then your portfolio managers will kind of come in and manage the money and the introduce asset allocation, etc. So we'll have to assess both components. You might feel that the fund sponsor side is a bit abstract, right? You don't really like, oh, like why would they want to assess the fund sponsor? But we'll try to see and understand. Right, so that's a quick overview of what we're going to cover today. Of course, as usual, you know, if you have any questions, feel free to unmute yourself, or if you like, you just type in a group chat and we can have a discussion on it. All right. Okay, so components of performance evaluation. So this is something that you can read through. Basically, you know, you can also measure type of returns. We'll look at a few measures of returns. We will be looking at, you know, some performance attribution. So this idea of attribution analysis, basically we want to dissect, right? Okay, so for example, if you have a return of 10%, so we are trying to dissect where does this 10% actually come from, right? Is it from the portfolio manager asset allocation, or is it from the portfolio manager's selection of stocks? So those are things that we want to find out, right? That's why we call it attribution analysis. Of course, there will be some kind of appraisal that will be done, whether the manager is good, whether it achieve its goal. And remember, at the end of the day, your goal is determined by what you agreed on in the IPS, right? So, and you are serving a client, means that everything that you do must serve the client, right? So it's not your own goal, it's not the market goal, but it's the client's goal. We'll cover a bit on this GIPS. There is actually a very long discussion in your study guide, but in terms of the course, we will not really go so in detail. So this standard basically it's created by CFA. Okay. All right. So this is a quick, another repeat. So we'll look at performance measure. So what was the performance? Attribution. Why did the performance occur? Appraisal. So appraisal was the performance due to luck or skill? So that's how we appraise the manager. All right. And who should measure the performance? How often? So and how should the performance be measured? So we'll cover all these detail today. All right, so let's look at, first of all, so there'll be quite a few mathematical formulas. Good thing that it's an open book exam, so you can refer to the notes, but it's important to understand the intuition. So as usual, I like to explain to you what's the intuition behind the formula. And of course, if you want the details, you can just look at the slides, right? Because there's a lot of words, basically. All right, so let's understand how we calculate return first. Remember, we mentioned there are a few methods of calculating return. So the most basic, right, the most like layman, very easy way to calculate return, when there are two conditions here, when there is no intra-period external cash flow, meaning that in between the investment holding period or investment portfolio period, there is no like changes that's happening, right? So if there's no changes, I guess the easiest way, you don't even have to look at this formula to understand, is that you just take the before value, or sorry, the after value of the portfolio minus the before value divided by the before value of the portfolio, right? Which is exactly what is being done here. So the intuition is very simple, right? So just think about how do you measure a portfolio return, right? If there's no cash flow, nothing. So you just do like yeah, this is probably like primary school kind of mathematics. So that's the easiest way, right? That is when there's no external cash flow. Right, so this is the first method. I'm sure like this is not difficult for anyone. Now the next method is when you know what, there is some cash flow, all right, but the cash flow happens at the start, so there's no intra period. So that, first of all, there's still no intra period. Intra period means that in between, right, there is still no cash flow, but there is a cash flow at the start. Again, this is quite simple to understand, right? Just, you don't even have to look at the formula. Just imagine if you have a cash flow that started, let's say, in the year 0, right? There's a cash flow. Obviously, this cash flow will be added to the total value of the portfolio at year 0, right? Which is why we have this thing here. And the question is, oh, so what is the returns of the portfolio? We just take the final value of the portfolio, which is this, less of what is the initial value of the portfolio, right? And then we divide by initial value of portfolio. So again, this is quite intuitive. And it's just written this formula just to show you. But if you imagine this in a real life situation, yeah, it's quite intuitive, right? So if you have a cash flow at the start, you just add it into your start value of your portfolio, and then you just take the ending value minus the start value, right? And then that's all. Okay. Again, the third measure is also quite intuitive in the sense that what happens if the cash flow happens at the end? So at the end only, and there is no intraday, right? So we'll tackle intraday a bit later on the next few slides. But if there's no intraday, cash flow, meaning there's no cash flow in between, then what you do is that if it's at the end, it shouldn't be considered as part of your returns, right? Of your portfolio, right? Because your portfolio didn't generate this cash flow for you. You just had a cash flow that happened at the end, right? So because of that, we should just ignore it. And mind you, I would like to highlight that these are external cash flows. So we're not talking about like, oh, we have a bonds and then like the investment in that bonds will yield like a coupon, right, to you. Those are called internal cash flows. So these are external. So external to your investment portfolio. So so yeah, you know what? This is again quite intuitive in the sense that, oh, if it's an external cash flow, it doesn't relate to my portfolio. I should just remove it, right? And it happens at the end, of course. So you just remove it from the end value of your value of the portfolio, right? Again, you just minus by the initial value, divide by initial value, right? So far so good. Everyone's all right with these three formulas. So again, this lecture you'll see a lot of formulas. But what I'm trying to bring to you, or what I think value add, is that I'm trying to make it more simple in the sense of how do you imagine this in the most simple way, right? Rather than just memorizing a formula and just plugging in the numbers. So at least this, next time, even after this course, you probably do remember this because it's quite intuitive. All right, so let's move on to something a little maybe less intuitive, but we can still think about this. And this is when there are intraday period external cash flow, meaning what? There are cash flow that is happening in between the holding period of your investment, and these are external, meaning you're like adding money in the portfolio. You keep on adding money, right? Or you take out money from the portfolio. Okay. All right, so we try to use this thing called time-weighted return. Is required under the CFA level 3 or the CFA performance evaluation requirement, which is this thing called GIPS. So how does this time-weighted return works? Basically, it is trying to make it as if there is no external cash flow occurring. Okay, why I highlight as if is that every time there is a cash flow happening, we will treat that as one period. So let me try to pull out a pen to explain to you. All right, so for example, this is the timeline, right? And this timeline is not by years. This timeline is by number of cash flow happening. So every time, so it starts with 0, there is no cash flow. 1 means there's a cash flow here. 2, there's a cash flow here. 3, there's a cash flow here. 4, there's a cash flow here. So this could be in 1 year, right? So let me just write here y equals to 1. It could be in 1 year, there are 4 cash flows happening. External cash flows, I mean. So every time there is a cash flow happening, you treat it as one period. So there's one period here, one period here. Maybe, you know what, in year 2, so year 2, Y2, there could be just 5 and 6. So 2 cash flows in year 2. So basically, you don't care about the number of year, but you just treat each period that cash flow is happening as a period that cash flow is happening. And because you're treating as if when the cash flow happens as each individual period, it means that you are treating as if there is no cash flow occurring at all. Because every time there is a cash flow, you treat it as a period. All right. And if you try to imagine it this way, it's actually kind of like your compounded return, right? So every time you have cash flow happening, let's say in the first number 1 here, your portfolio will grow by R, right? Let's say let's put it at R1, and in number 2, let me just change the color here. In number 2, you have R2, and then you have R3. So every time there's a cash flow happening, your portfolio will grow by R. And what does this mean? It means that if we treat it as compounding kind of returns, we simply remember compounding, we just add 1 plus R1, then times 1 plus R2, blah, 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 then you minus until n, then you minus 1, which is exactly what this formula is giving you. So it will compute the rate of return for you for the entire period by treating each cash flow that happened as like as a period to consider, and therefore it's as if there is no cash flow happening, no external cash flow happening. Any questions for this? So this is just the intuition, right? We'll see an example of how we implement this in a problem, but I'd like to try to give you how do you understand this time-weighted kind of concept. So if any questions, let me just erase everything. Any questions, feel free to just type on the group chat, yeah? Okay, so much for time-weighted. I think we'll look at a few, one more thing called money-weighted. So money-weighted, so time-weighted is a bit, I wouldn't say it's exactly like a compounded return, because if you know compounded return, then you need to square root it and all those things, right? Not really square root, but you need to reduce it by the to the power of 1 over the number, 1 over n, right? So it's like compounded return, but not exactly. But I like to usually think of it as like a compounded return. Now, in terms of this thing called money-weighted return, again, it is like your IRR. If you recall what's IRR, it's called internal rate of return. So I'm just going to do a quick like recap for you of IRR, and this is in your year 1 lecture. So what happens in IRR is that, let me just pull up my pen again. What happens in IRR is that you have a cash flow, right? CF1, and then there's this 1 plus something, right? Something here, you don't know what's this. Then you have the CF2, and then 1 plus something again, but then you need to bring it by a factor of 2, right? Then you have the CF3, and then 1 plus something here, which is a rate that you are trying to find out, like let's say for 3, right? And then at the end of the day, remember for IRR is that what is the rate, which is this question mark here, that will cause your NPV to be 0, right? We are looking for 0 NPV. I hope you remember what's NPV, net present value. So IRR, basically, you're trying to find what is the question mark that will cause your NPV to be 0. I remember we press our calculator. It's quite easy to do this in your financial calculator or even in Excel. You just plug in the various cash flow and you just use IRR functions and voila, you will just get a percentage, right? And so basically, we are using the same concept here, okay? Let's look at the formula and you'll notice the similarities, all right? But so this is basically your IRR, and we're using the same concept here to calculate this thing called money-weighted returns. Okay, so basically, whatever that's mentioned here, it's kind of just explaining to you what's this money-weighted return. What's important is that it measures the actual return of portfolio considering the manager's action and the timing and size. So this is important, timing and size. As you notice here in the IRR formula, if you think about IRR, is that if your size of cash flow and what is the timing, right? Whether it's year 3 or year 1, it actually affect your eventual calculation of your IRR or your rate here, right? So it actually considers the timing and size. But remember at the previous formula that we look at, it kind of didn't really consider too much of the timing, right? Size maybe your impact, but like timing, if you notice, you just multiply 1 plus something and then you just keep on multiplying. So the nice thing about IRR is that you consider both the timing and size, or what's nice about this money-weighted return. All right. Okay, let me just clear this. And let's look at the formula. So now, do you notice the similarities of this formula with the IRR formula? So remember, IRR was the cash flow divided, right? by the 1 plus question mark to the power of something, right? Remember, I was put to the power 1 for the first cash flow, the second cash flow to the power 2. And this is exactly the same. But remember, for IRR, we're making NPV to 0. But this, we're not interested in making NPV to 0 because this has an actual NPV, which is your market value of the portfolio at the final year, right? So in that sense, with this concept of IRR, basically it means that, you know what, your market value of a portfolio at the final year or eventually is equal to the market value of portfolio at the year 0, multiplied by 1 plus this R, which we are trying to find, to a power of the number of periods. So let's say there are like 5 years, right? Let's say I'm holding a cash flow for 5 years. If it's 5 years, then this will be just so this will just be 5, and then this is 4, this will be 3. So basically, what is this L minus 1? You know, looks a bit complicated, but don't worry about it. Basically, it just means that at the start is the full year, the 4 year, 3 year, 2 year, 1 year, and that's all. And then the 0 year, there's nothing. Okay. So yeah, this is kind of like the IRR formula, if you notice. And what's the purpose of this? So we know the market value of the portfolio at year 1. We know the market value of portfolio at year 0, of course, we're at the start. And we know the M's. So in a sense, we're trying to deduce what it is R here. All right, we are working like almost backwards, like IRR. We are trying to find what's the R value. And once we find what's the R value, we plug it into this basically quite a simple formula. Just 1 plus the rate to a power of number of periods. So if it's 5, this will be 5 minus 1. All right. And we get this thing called money weighted return. So the question is, how do you find what's this R? So this R, basically, you just simply use the IRR formula in Excel. I believe it's not called IRR, but it's another formula. But basically, it uses the same kind of try and error method, and then you'll just give you a figure of R. Any questions for this? Yeah, so this is for portfolios. Yes. Yeah. So MV is the MV1 is the final value of portfolio, MV0 is the present value of the portfolio. So why is this only for portfolio? Is because yes, you can use it for like single stocks, but if you use it for single stocks, it's actually just very easy to do the returns, right? Remember your very simple kind of what's the expected return for a single stock and all those, right? But remember, this is for portfolio and it's more of like an evaluation measure, right? So we are trying to find out what's the return, and then we are going to, remember, at the end of the day, we are trying to make a judgment. Oh, is the return of portfolio good? Is the manager good, right? So the purpose is not so much about, oh, I'll calculate portfolio return, I'll calculate portfolio standard deviation. These are not what we're calculating. Remember, we are doing performance evaluation now. So that's why the methods are slightly different. It's simply just not like, oh, this is portfolio return, this is portfolio standard deviation. So this is more like, oh, how do we evaluate the manager? Okay. Yeah. So if you want to get per year, so this is for the entire evaluation period. You can actually annualize it by dividing by average it. So you do a simple average, right? But what's easier, right, is that if okay, so if you do a simple average, you so-called average, do a simple average of the returns. But let's say if you are usually interested in a 1 year usually people are not interested in 1 year lah. Okay, but if you're interested in 1 year, right, then you just do a 1 year thing lah. Like you just do this. So you omit all these formula. You just look at what's the 1 year return, right? Because remember, all these are so-called we call it ex-post. I hope everyone knows what's ex-post. Ex-post meaning that it has already happened. We're not like forecasting. We're not using probability. All this already happened. So it's ex-post data. So if we want a 1 year, we just take this up. Yeah, but of course, if we want an average, then yeah, we can take 3 years and then we divide by 3 to find the average. All right. Okay, so we have a quick example here to try to explain to you or try to let you understand what is this time-weighted rate of return. Okay, so Mary has an investment account in a local firm. She makes contribution to account as the fund becomes available. So contribution meaning these are the external ones. So whenever you see this contribution means that there's external cash flow happening and most likely like intraday. So we cannot use the 3 basic formulas. We need to use time-weighted rate of return or the money-weighted rate of return. All right. Okay, so she begins the month in September with a balance of this. That 100K, she received a fund in the amount of 3K, we deposit the account in September 14. She received a payment of 2.5K in September 21. And the value of account after the first contribution is this. So, and then the value of account, so this is the initial, after first contribution is 105, the account value was 108 after second contribution, and the account was valued at this. So if you immediately notice that, okay, she started with this, right? But during the year, there was some growth in the account, right? She has put in 3K, but then you can see it grows to 5K, right? There's additional 5K. So there is some returns that's happening in the account, but we need to so-called remove out all the funds that she put in, the intraday funds, so that we can actually deduce what is the growth of the account. And remember, all these are for valuation performance. Okay, so let's see how do we do this. We basically use the same formula, but we need to calculate, first of all, what's the return, right? Remember, we need to calculate R. I'm just going to quickly jump back to this formula here. We are exactly using this, but what we're doing now is, let's see how do we calculate R, because now we have like intraday fund top up, right, or fund cash flow. So we have, we know that after the first year, there's this in account. She added 3K, right, and know the initial was 100K. So we can actually find what is the return in the first year by simply just, this minus this minus this. I think this is not too difficult. Everyone should be able to see this. If you can't, please just write in the group chat, so I'll explain again. And then we do this for the second and third year, right? So basically, we're just trying to, first of all, remove away the cash flow that was happening, that she added the money in. And then we remove what's the initial cash, so-called the value of the portfolio at the start of the year, right? Let's say this is a start in year 2, right? So what's the initial value? We divide it by initial value again. That's how we get returns, right? That's how we get the percentage returns. Now, having calculated the percentage returns, we just plug it into this time-weighted rate of return formula, which is, again, based on almost like a compounded return that I mentioned. So we just plug it in, and we should get this answer here, right? Any questions? Oh, okay, then we will proceed. Okay, so this is just a short comparison kind of table. What is the difference between time-weighted and money-weighted? As you already know, like questions will come up in kind of like a study. So at the end of the day, choosing which method might both be correct depending on the context, but we need to be able to justify. So when you recommend a method, try to justify so why you choose time weighted or money weighted, right? So that's why I try to give you like what's the differences. So money weighted basically represents the average growth of all money invested. Well, I remember the time weighted, we talk about how we put like every single cash flow as like one period that happened, right? That's how we work the time weighted, right? So every time money happen, we treat it as a period, and therefore as if there is no external cash flow happening. All right. Just now we already mentioned this, that money weighted is sensitive to time, size, and timing, because remember when we try to think back to the IRR formula, we see that, oh, every time there's a cash flow and a different timing, you actually impact the calculation of IRR. So in the same sense, you impact your the calculation of your money weighted return. So time weighted requires the account to be evaluated on every single date the external cash flow takes place. Again, we already talked about this. Remember, every time there is a cash flow happening, we need to create a period, right? Period 1, period 1, period 2, period 3. And let's say in a year, there's like, I don't know, 50 cash flow happening. Then there's actually a lot of work to do, right? So every time a cash flow happens, you have to create a period. And what if the cash flow is super small? Let's say it's like 1K, the external cash flow is 1K. So like it's so much work actually to do the time weighted. Okay. Again, time weighted, of course, accurately reflects how the investors fare during the evaluation period, because we consider each period in cash flow. Of course, the fund contributed to account prior to the period. Okay, so this is interesting. So the fund are contributed to account prior to a strong performance. If the fund is contributed prior to account of strong performance, then the money weighted is positive, right? Compared to the time weighted. So how do you think about this? So in the money weighted, right, you notice that there was like, if you think back to IRR formula, right? So if the money is contributed earlier, it will be discounted more, right? But in your money weighted, it means that it will be compounded more, because you notice that the denominator for IRR formula is 1 divided by IRR, right? But this money weighted is the cash flow multiplied by 1 plus the R value, which is what you're trying to calculate. So basically what it means is that if you receive the money first, because this money weighted considers the timing of the cash flow, is much better. All right. Okay, so which should be used, again, something you can read about. Basically what I'm trying to say is that, like the time weighted, we have to consider every time a cash flow happens, right? And this might be quite troublesome because cash flow might happen so many times. So because of that, the time weighted might not be so good. And the money weighted just kind of consider as a start at the end. And basically that's how you just evaluate. So if your portfolio is 5 years, you just at the end of 5 years, you just compute everything and then that's all. But for time weighted, you have to do every time the cash flow comes in. So there's a bit of drawbacks here and there. If the investment manager has little control of the size and timing, maybe the time weighted return is more appropriate, because if you have control of the size and timing, then you can impact the return, right? Then therefore the money weighted might be more appropriate. So remember, at the end of the day, right, what we're calculating is all for performance measure. So if the manager can actually control the timing of cash flow, then obviously we should give him the benefit, right? Or we should so-called attribute or like consider the benefit of him moving the cash flow here and there, right? Because if you have control, then he can move the cash flow, the size of the cash flow, then we should attribute that and use an appropriate, accurate measure such as the money weighted. Right? So that's the purpose of why we use the money weighted. So again, this one's relating to your time weighted, where if you have to mark the account to market, meaning that if you have to at every single period calculate what's the return, it is very administratively expensive, of course more prone to error. Okay, alternatively, there's this thing called the linked internal rate of return. Okay, so this method looks, looks fancy and all, but it's actually very simple. So I'll just jump back a few slides. So remember at for your money weighted, what happens is that we calculate a money weighted return by taking 1 plus R to a power of n minus 1. So what is this linked IRR? So a linked IRR basically combines your time weighted with your money weighted, meaning we're going to use this formula to calculate your linked IRR. And how do you get the R from here? We use your money weighted method. All right. So why I didn't put the formula here is because you don't need to know the formula. You just need to know that this thing exists. So what is happening here, to just give you the idea, you don't need to know to how to calculate and all, is that once we calculate the IRR, and this one we need to consider a few periods. Okay, so we calculate a few IRR. So what happens is that we have this IRR 1, and then we have your 1 plus IRR 2 and 1 plus IRR. Let's say you have three periods. So we need to have a reservoir frequency interval minus 1. So this is your link. So basically you're linking your IRR together. All right? Any questions for this? So again, this one you don't need to know how to calculate. It's just you just need to know it exists. Okay. So that is one portion on how do we determine the returns in terms of performance evaluation. Now we need to think about next is benchmark. Okay, so what's a benchmark? So the intuition of a benchmark is that a benchmark is something that you are going to compare your portfolio returns with. Okay, so you have a benchmark, and whatever you want to compare, so whether the portfolio is performing well or whether it's performing badly, we want to compare it with a benchmark. So we have first learned how to calculate what's the return of the portfolio. So now we need to calculate, or we need to understand how do we construct a benchmark where we can compare our portfolio to. Okay, so we try to understand the breakdown of benchmark construction. So again, I want to repeat, this can be a bit abstract to you because you are now not taking the portfolio manager kind of approach. We are actually taking more like the fund sponsor. So as like the so-called your CEO or your big boss, right? How do they actually construct all these things? Obviously they don't, but like they get people to do it. But how do they think about these kind of issues, right? And then they will push down the sort of KPI to the fund manager. For example, if you are a fund manager, yeah, they'll push it down to you, and then you'll compare your returns to each benchmark. So we're trying to think, how do they construct all these things? So the benchmark, we can measure it in the market, the style, and whether it's active management. All right, so we'll look at 3 components here. So when constructing a benchmark, we can think of it, first of all, in the market return. Right, so what is the return on the market? So that's the base first. So what's the market return? Basically, S&P 500, basically the diversified portfolio, right? Now, what is a style return? Okay, so what's style? I hope you do remember what's equity style. So equity style, remember there are two things, right? If you don't remember, go back to I think lecture 2 or lecture 3. We talk about this thing called growth style and growth and value style. Anyone can remember what they are. You can just type it in the group chat. What is a growth style? What's a value style? Anyone recalls? Growth, value. So one of them is you buy something that is understated, right? Like the stock price in the equity is understated. Yeah, okay, thanks. Yeah, so growth is you buy something that would potentially grow. So it's almost like buying blue chip stocks, right? Because you expect that this company will do well, they'll grow, they'll get better. So those are growth stocks. Your value stocks, yeah, fundamental, that's right. So fundamental meaning that maybe they are underpriced, right? So they have their value, the fundamentals are good, meaning that the book value of the stock is high, but the market is trading it as like a cheap stock. So you can buy something that you know that after doing a fundamental analysis, yeah, this stock would improve in value over time. Okay, so style returns, so measuring, constructing a benchmark with the style, we can do it by measuring the difference between the benchmark index and what's the market index, right? So by determining what's the difference, we can see, oh, are you doing a value count style or growth? Last but not least is about active return. So this one, we are measuring what's the difference between the return on the portfolio minus the return on the benchmark. Meaning what? How much of the, how active is the manager, the portfolio manager, in determining what's the final value of your portfolio return. So if you compare the benchmark that you have created with the portfolio returns, we immediately can see, oh, so if portfolio gives me 10% more than your benchmark, means that the managers are actually putting in, I guess, are contributing 10% more in terms of how they trade the stocks, how they weigh the stocks, and these are all active kind of management techniques, right, by the portfolio manager. Okay. So the idea is that sometimes we need to be careful, even as a portfolio manager, that there might be some kind of style drift that happen, meaning that initially you might be focusing on like a fundamental or kind of like a value stock or value style, value equity style. But remember, as your stock price increase, you have to reweigh or reallocate your portfolio, right? Rebalancing that we talked about last lecture. So if you don't rebalance, your style might drift further, right? For example, it could be more and more to the value, and it's too much value weighted, and therefore it's not so good. So we just need to be careful of this style drift. We need to remember always fall back on the IPS and just be careful. So what's this Madoff feeder fund? So I'm not sure whether any of you all know about this person called Madoff. Basically, what happens is that, I guess in 2008, what happens is it was almost like a Ponzi scheme. So he has a business on asset management. So he managed a portfolio of asset. This happened in the US, right? So he managed a portfolio of asset, and as usual, what happens is that he took the money for himself, right? So he was a boss, he was a CEO, he took the money and he stashed the money away. Then he employed his like kids as part of the board and the top management, meaning like I believe the daughter was like head of compliance, and the son was like head of investment. Basically everything, right, is very family owned. There is no transparency, there's nothing, right? And there is no external checks and balances. And basically what happens is that they took a lot of money, billions of dollars, and eventually got caught. And I think he was sentenced to life imprisonment. But he passed away after that. It was quite tragic. So I think the son hanged himself. The daughter also did something and passed away. So basically, everyone kind of died at the end. Yeah, it was a very tragic story. Yeah, largest Ponzi scheme. Yeah. He was the guy, the mastermind Madoff, I guess the father. I guess I was reading he was sentenced to 150 years in prison, which basically means life in prison. Apparently, it's the longest kind of prison sentence they can get. So yeah, basically what I was trying to say is like be ethical, right? And don't, sometimes when the money is there, it can be very tricky, right? Hopefully, one of these days, when you're up there, when you are earning the big bucks, right? Remember what you have learned here in this lesson, right? Just be very careful, and not be greedy, basically. Okay. I'm not going to go through every single line of this. This is just, again, some pointers for you to understand. Almost like, nowadays, maybe not nowadays, but like years ago, people were talking about what SMART goals and all these things, right? What SM, and they have all the abbreviations, how your goal should be SMART. This is kind of like similar, if you can think about it. Something that has measurable, appropriate, specified in advance, and all those things, right? So basically, we're just trying to, or what I'm trying to explain here is that we're trying to create a benchmark that is specific, it's accountable, it is black and white, right? Unambiguous, it's black and white. You actually mentioned it in the, I guess, the IPS, or even like a contract with the fund manager. So everything should be accountable, should be transparent, and so people know what to work towards, right? Almost like most of some of you that are working, that you have your KPIs, and usually the KPIs are very specific. They are numericals, they are quantitative, so that you can actually measure it. So in the same they are trying to say in the terms of the benchmark. So accountability, yeah. Investability, able to invest all the assets, okay? Okay, so type of benchmark, just want to quickly mention that there are few. There's absolute in terms of percentage, median. Median means what? On a fund sponsor level, remember when it says fund sponsor means like the person injecting money into your portfolio management firm. At a fund sponsor level, they might look at all the various portfolio managers, right? Because you have like, let's say in a asset management firm, you have like 10 portfolio managers. So they'll look at the average, what's the median portfolio manager? Are you above the median or below the median? Why they use median? Because usually you don't have too many portfolio managers. So mean can be a bit skewed sometimes. So median is good because it's not subject to skewness. Skewness means like extreme ends, right? So some managers are super good and some are very bad. And if you have a mean, basically you absorb both the extremely good and extremely bad, right? So it's not so good. So it be skewed. So use median instead. A broad market index, we can use, let's say, S&P 500. Does your portfolio exceed S&P 500? Style index, you can see based on the type of investment you do. For example, you are focusing on small caps, then you can see whether compared to small caps, are you doing better or not. Again, there are many types of benchmark. there's this thing called a factor model indices. And basically a factor model, what happens is that you are trying to do a regression model. So when we do regression, what we're trying to do is we have some data, right? We have some return data and maybe return over time. And we try to see, oh, based on this return and the time, we can compare, let's say, the average return that all the managers should have. And we compare this so-called regression line, right? Y equals mx plus c. And we compare this line with every manager. So is the manager above the line, below the line? So almost like we do like a benchmark, right? And then we use by using a regression technique. So what this factor model is trying to say is that there might be multiple factors that's contributed into the regression. And the problem, or not a problem, but the good thing about regression is that it captures all the various data. So for example, return might be one variable. Remember, y equals mx plus c, that's one factor, right? X is. So what I'm trying to say is that you can have x1 plus x2 plus x3. So basically you have many factors here. You have x1, x2, x3. And because of that, all these can impact, let's say, if you are plotting regression over R, this can impact your R. And in that sense, right, sometimes it's very hard for the manager to think of the returns like in the form of a regression every single time it makes a decision. So it might not be so intuitive, right? Yes, this might be good as a benchmark kind of thing, but how accurate is it actually trying to depict the manager's style? It might not be so accurate, right? Data might not be available as well sometimes, so it really depends. Next, return base. We can look at the past manager's return. So basically historical, is he performing better than historical or he's still doing the same? Customize, of course, last but not least, is you basically just customize based on the manager. So you tweak the benchmarks. So test of quality of benchmark, quite a lot for you to just read through. A little dry, I feel, but just be careful so that you could have systematic bias in your benchmark, meaning that, if you systematically did not do something, or like, for example, if you're drawing data from a certain database, right, to create a benchmark. Let's say the database is, they always, let's say, underreport certain things, right? I mean, underreport the return for like agriculture stocks. And because of that, you might introduce certain systematic biases into your construction of benchmark. So just be very careful. One thing I want to highlight here that's interesting is that historically, the historical beta of the count should be relatively close to the benchmark, and it should be 1. So anyone can recall what is the market beta? So what is market beta? What's the numerical value of a market beta? One, perfect, right? So generally, right, stocks that have beta above 1, they are more risky than the market, right? And stocks that are below 1, they are less risky than the market. So now, instead of comparing with the market, remember we are doing benchmark, right? We're comparing benchmark. So what it's trying to say here that if your benchmark is like the market, it means that benchmark is 1, right? So whatever portfolio that you create on top below, meaning that more risky than the benchmark or less risky than the benchmark, should reflect the risk compared to the benchmark. But at the end of the day, it should be close to 1. So it shouldn't be too much above the benchmark, because remember, the benchmark at the end of the day is created based on the what's allocated to you from the fund sponsors, how much risk you can take, etc. So your portfolio that you create as a portfolio manager shouldn't be like, oh, 1.5, 1.6, which is very high for the beta portfolio. So this is what I'm trying to say. You should be relatively close to the benchmark of 1. So another thing to take note is that the correlation between active and style return should not be statistically different from 0. Meaning what? Remember, you have 2 kind of return, right? We have style and active return. So it means that it should not be correlated to each other, right? Whether you do active style or whether you do active or style kind of return. So it should be separated, should be uncorrelated. Right? So then we can talk about other things like tracking error. We have mentioned this, meaning that we should not be tracking, we should avoid too much tracking error. If you are tracking the, let's say, S&P 500, but in this sense, we're talking about benchmark. So your portfolio should not be too far off from the benchmark all the time, right? You should be quite close to the benchmark. So again, this is similar to what we mentioned about beta. The systematic risk, which is measured in beta, should be quite similar to the benchmark all the time. So what's interesting or what's important to take note of that in this component here, where you talk about tracking error, talk about systematic bias, everything is compared to the benchmark. So it's no longer compared to the market, which is what we kind of usually think about, right? When we think about, oh, how much systematic risk you're taking, you are basically comparing it with the market beta. But now your market beta is your benchmark. So you're comparing your portfolio to the benchmark. Okay, so that's how you can think about things. Now, test of course, continue again. We talk about the coverage of the portfolio. So how much of the portfolio, how much percentage of portfolio is the portfolio compared to a benchmark? So is the coverage of portfolio like 100% of the benchmark or 30% of the benchmark? Obviously, we should have a higher coverage of the compared to a benchmark, right? Because we set the benchmark as a guide for the portfolio manager as well. All right, so what is this thing called turnover? So turnover means what? That, you know, every time, let's say you have a portfolio and then the stock of the portfolio increase, right? And this portfolio is constructed and to be used as a benchmark for your managers. So when you construct the benchmark, or which is like a portfolio, the benchmark or the stocks in the benchmark will also increase over time, right? Because it's very dynamic. Benchmark is not very static, right? It can be very dynamic. And because of that, let's say the stocks in your benchmark increase drastically, then you have to do, remember, reweigh, you have to rebalance, and this will cause this idea of turnover, basically like, you know, like human resource turnover, right? You need to change your stock, you need to sell your stock, you need to buy your stock, whatever, right? So this is called turnover. And the thing is, we do not want your benchmark to keep on having too much turnover, simply because if it's so volatile and you keep on having to change, reweigh, rebalance, then it's very hard for your portfolio manager to regularly measure their returns on the benchmark, because your benchmark will keep on changing, right? So basically what I was trying to say that a good benchmark should not have very high turnover. All right. Yeah. So if it's a short play investor, meaning that if you're a portfolio manager and the duration is short, let's say 2 years, then the effect of turnover will not be so great. But do generally take note that usually for portfolio management, it is more medium to long term, as you have noticed in a lot of the cases as well, and it's quite true. If you are looking at short term, usually it's more like trading, right? Yeah, like a trader. So that is slightly different. So when you talk about portfolio management, usually it's a bit more longer term. But yes, you're totally right. So it should be good for short play investors. Uh, okay, so let's take a quick 7 minutes break. We'll be back at 8:12 or yeah 8:13 around there. And then we'll continue on the attribution and appraisal. Right. As usual, if you have any questions, feel free to just put it in the chat. All right, welcome back. Hope you have a quick, short break. Let's continue. So now let's talk a little on this thing called attribution and later appraisal. So again, like what I mentioned earlier, attribution is how do we determine what aspect of the performance is caused by certain things, right? So we're trying to attribute the various returns or whatever, or performance of the manager to certain components. Is it his skill? Is it the way he reweigh the portfolio? Yeah, so we're trying to understand how we determine that. Next, this will be probably the last part, is more the appraisal part, right? So are we able to say that the manager has skill and ability to outperform the benchmark? So this is important, skill and ability, right? So at the end of the day, I think in the first lecture you mentioned, right, if the portfolio manager just buys the market, meaning like S&P 500, just buys the market, then there is no value in terms of the portfolio manager, right? Because everyone can just buy the market. So the skill and ability comes when he outperformed, but like, why did he outperform? Is it because of his skill and ability? So this is the appraisal part. But let's look at the attribution part first, right? Okay, so for attribution, there are two main parts that we look at. First is the fund sponsor side, which we'll think about it as the macro attribution. And then later we'll look at the micro attribution, which is the investment manager. Right, I want to highlight again that the macro attribution could be a bit vague or like very obscure. Like you might not like try like kind of understand because it's a bit further up in terms of the organization hierarchy, right? But we'll try to explain it in a more simple term. But when we look at macro attribution, it might be a bit more familiar. Or it's almost like for those that are working, it's like your KPI that you have to meet. All right. So at a fund level, macro attribution level, we need to understand, how well is the fund sponsor actually allocating assets to various classes and even selecting asset managers, right? Because the fund sponsor will allocate assets, and then the fund manager will be the one that picks the asset from each allocated category. For example, a fund manager the fund sponsor might say, okay, we have 30% equity, right? So they set that as the allocation. Is the investment manager that is the one that say, let's pick the asset, for example, let's pick ST Engineering, or let's say we pick Keppel. So those selection are done by the investment manager, but in terms of the location is done by the fund sponsor, right? So that's how the interplay between the portfolio construction happens. So we'll first tackle micro attribution. So this again, I'd like to highlight is the fund sponsor level of analysis. There are actually 6 strategic levels. We'll look at it in a bit. Basically, at fund sponsor level, we have quite a few things that they have to do. For example, the allocation policy. We talk about benchmark. Remember, so they will set the benchmark for your portfolio manager. Based on your fund returns, external cash flow, etc. that we talk about. So usually the fund sponsor will set more of a long-term kind of goal for your portfolio manager in terms of the targeted asset allocation, and based on the benchmark, that's where the portfolio manager will kind of select the various asset in the asset allocated classes. We'll look at this thing called return metrics, and we have 2 kinds, which is the return metrics where it's just a percentage, or the value metric, which is a dollar return. All right, so just as a fancy name to say, one is dollar return, which is value, and the other one is the return, which is percentage. So this is a repeat. The fund manager will determine the broad class, so you can just look through it. Broad class of asset allocation. All right. So I'd like to show you this diagram to explain to you how is this attribution actually works. So we look at the bottom first, at the managerial decision level or macro attribution. This is your fund manager, right? Or your portfolio manager, where they do the sector allocation, we do the select the securities. For example, I told you whether they should buy ST Engineering or should buy Keppel stocks, etc. Right? Now, at a higher level, where this is where we're looking at, which is the macro attribution level, this is where the money is being pumped in by, let's say, big funds, right? Big funds can be, for example, sovereign wealth fund. We can think about State Street, or even like Temasek. So they're big funds, right? So they might push down some or pass some money to these asset managers, and then the asset manager or the fund sponsor would say, okay, we need to allocate, let's say, 30% to equity, 50% to bonds, etc. How much must be actively managed? How much must be, let's say, sitting in gold that is not actively managed? And then from there, the fund sponsor will kind of determine, okay, what is the various asset allocated, like in terms of, like, let's say, the sector, right, or industry. So how much must be in manufacturing, how much must be in agriculture. And from there, they also will employ the active managers, right, to manage the subdivision of the portfolios. And then, of course, then the manager do their work, right? So at this level, we also have to determine how well the fund sponsor is performing in terms of this management here, right? So that's the macro attribution. So as usual, as mentioned, it's a bit higher level. So in terms of that, we'll look at, let's say, the policy allocation, right? So the fund sponsor to determine what is the weight of each category of asset that's allocated to each manager, and whether it satisfies the long-term objective and constraints of the fund itself. So of course, the fund would have its own long-term objective. For example, I think the Temasek is to maintain the wealth of the nation or something like that, right? Like to grow by how many percent, they have some mandate they have to do. So basically the fund sponsor will have to distribute the assets or the funds to ensure that it meets its long-term objective. So like I mentioned, the fund sponsor can also tasked to create benchmark for, let's say, each asset or even each manager, so that they can compare the portfolio manager's performance on the benchmark. Last but not least, we look at the various matrices. Remember, we mentioned earlier that it can be based on dollar value or percentage. So the fund sponsor also determine what is the kind of fund returns, the valuation, and kind of cash flows that is necessary, right? And those are all in the investment policies that will determine how the portfolio manager actually perform their duty. All right. Any questions so far? Good. Yeah. Sorry about it. I think my voice is a bit, having a bit of a cold, so and a sore throat. So yeah. So there are 6 main decision levels that we need to consider for macro attribution. So and this might look like a repetition, it might not be too new. So these are 6 decision levels, right? So they include, the net contribution, risk-free assets, what are the categories, the benchmark, investment managers. So these are all like various factors and that the fund sponsor has to consider in terms of its macro attribution. So type of benchmark, the selection of your investment manager, what's your allocation. As usual, so the fund sponsor also has it's got a policy or a document that they have to follow, right? Meaning that, okay, they are being allocated the funds. for the asset management, but the fund sponsor will have to follow this document based on, like, let's say, oh, we have to allocate 30% to equity or 50% to bonds and 50% bonds. But yes, they might be, let's say, they might actually go above 30% of equity and let's say below 50% of bonds. And this will result in this called the allocation effect, where there's some differences in terms of the agreement with the funds from the fund sponsor to the asset management firm. This is possible, but usually it should be zero, where there is actually no allocation effect, meaning that it follows the policy of how the fund or how asset management firm should allocate the assets. Okay. Okay, so that's all for micro attribution. So I'd like to highlight to you that for micro attribution, there is no calculations involved. And so far, I've not seen any questions on micro attribution. Most of the questions I saw is on, I've not seen any question on macro attribution, and most of the questions I saw is micro attributions, right? And as you know that this chapter has not been covered in both the TMA and GBA, and being like year 3, year 4, right? You know that usually the last 2 topics of each module are the ones the focus for your finals. So this micro attribution is very important, I would say. Okay. So if you have any questions, please stop me. I'll try to answer them on how you calculate this micro attribution. Okay. Okay, so now micro attribution, like I say, is important because now we're considering the portfolio manager level. We determine whether the portfolio manager is doing well, he's not doing well, and the reason why he might not be doing well or not. Okay, so the most basic form, again, we try to go back to intuition, right? The most basic form of a portfolio return, a value-added return, is basically we simply just want to compare the benchmark with the portfolio. Okay, so this formula looks a bit complex, but try not to be too worried. It basically just means what is basically the weight of the portfolio, the return of the portfolio minus the weight of the benchmark times the weight of the benchmark. So what we're trying to say, we are comparing first the portfolio with the benchmark, right? When we multiply it by the weight and the returns to get aggregated value for the benchmark, or the aggregated value for the portfolio minus the aggregated value of the benchmark. And the difference, obviously, if it's positive value, means that your portfolio is doing better than your benchmark, right? So this is the most basic form of how we calculate the portfolio value added return, right? So compare portfolio with the benchmark. Now, this is not enough because this does not allow us to attribute where the returns are from. So we're going to expand on this formula in a bit, right? So I believe it's the next slide, so we're going to expand on this. But the idea is that a good manager or good portfolio manager will somehow, either affect the W component or the R component, meaning the weight or the return, right? They select whether the right stocks, right, they give you high return, or they overweigh certain stocks that's doing well, right? So overweighing or selecting stocks, this will allow them to achieve a return that is higher than the benchmark. Okay, what's this last point here? The last point here is saying the exact same thing that we have mentioned since day one, right? If you're going to be a portfolio manager and you're just going to hold a diversified portfolio, right? S&P 500. And let's say you only do a different selection of one stock. So for one stock, that stock will be different from the S&P 500. Now, because of that, the diversification, or because your portfolio is so diversified, that impact of one stock selection is not going to impact your entire portfolio. And because of that, you become just a market benchmark. And that's not what you want if you're a portfolio manager. You want to show that you have skill. You want to show that you can beat the benchmark, right? So selecting a large diversified portfolio as a portfolio manager, it means that you're a bad portfolio manager, right? So a portfolio manager should be selective. You must have certain view, what do you think will happen, and therefore you select certain stocks. Okay, so earlier we remember we talked about the value added return, and then we say that we are going to decompose it or to segregate it into three key components. And again, I want to mention this is very important, especially for your finals, right? How you calculate each component and how you're going to comment about it, right? How you comment about each component. Okay, so this formula might look complex, but we'll try to dissect it individually and we try to understand how it works. All right, so these are just some of the notations. We have seen this already earlier, right? WP is for portfolio. The weight WBJ is for benchmark. Now, RB here is the return on the benchmark. Okay, so let's tackle each section individually. So I put the formula here to remind you. Now, let's look at this thing called the pure sector allocation. Again, all these are a lot of words. And I guess what I want to do here is try to explain to you what is the intuition so that you can understand the concept and you remember it. And if you ever need to write it in like a proper sentence, words and stuff, you can just refer to the slides, right? But what's the idea behind it? So the idea behind the pure sector allocation is that what we're interested in, if you look at this formula here, all right, is where is the weight of the portfolio versus the benchmark. So where is the difference here? So in this sense, right, if you look at here, so it's WP minus WB. So the difference is the weight of the portfolio versus the weight of the benchmark. And this difference in weight would result in the sector allocation. Okay, so because of this different sector, different in weight and the allocation to this sector, this will actually be the cost of the, let's say, the increase or decrease in the portfolio, right? So this is the sector-related allocation. Okay, so we simply look at here, and of course, we need to consider what is the return on the benchmark. Sorry, the return on benchmark minus the return here. Let me just go back to the slides. Yeah. So remember, for pure sector allocation, we simply are actually focusing here on what is the weighting difference, right? What is the weight of the portfolio versus the weight of the benchmark? And this is the one that affects your allocation to this sector. Okay, so now let's look at this thing called the second component here that we decompose is the allocation and selection interaction. So what's happening here, right, is that you notice that we are comparing both the portfolio weight and the portfolio return. So focus on so always focus on the term PJ minus BJ. So in this sense here, right, the PJ minus BJ is on the weights. So these are the sector, correct? Now, when we look at the middle term, the difference of PJ minus BJ is both on the weight and the returns, right? So PJ minus BJ. So this PJ minus BJ means that now we're looking at what's the interaction between the allocation and the choosing of your stocks that give you the returns. So this is now your interaction term, right? So we're looking at the interaction. So the joint effect of the portfolio manager and the security analyst decision to weigh each asset and the individual security. So individual security is the return, the weight is your W here. Okay, so this is the interaction term. So don't worry, there will be a problem that we'll go through, and this will be quite clear once you see the problem. Okay, so again, I repeat, focus on the PJ minus BJ component. So last but not least is the within sector. So what within? So that means now we already determine what is the weight, which is the BJ, right, the benchmark here, and how does the selection of the assets kind of attribute to the overall portfolio return. So this is the within sector. So again, I say focus on the PJ minus BJ, and the difference here is the return. So it's the return on the selection of individual securities. Any question on this? These three formulas here. I may have pause for a short while. Any questions? Okay, so maybe we are still digesting, not too sure. Don't worry, we'll look at a quick example. Just want to highlight here that, okay, so when imagine you don't have the names here, right? Pure sector allocation, selection, interaction, whatever. How do you determine what are you considering in each formula? So I want to repeat again, always focus on the PJ minus BJ. So in the first formula, the PJ minus BJ is on the weight. So we're actually considering the sector allocation, right? How do we allocate in terms of weight? I'm going to jump to the third one, where it actually is on the R component, which is the return, which is your selection of your securities, right? And the middle is the interaction, because you are actually interacting both the weight and the return, right? So that's an easy way to understand it. Okay, so this is an important example that I'd like to go through. If any questions, hopefully this would kind of solidify your understanding on this micro attribution and how it works. All right, so you have all this information. Okay, weight of the portfolio weight, sector benchmark weight, portfolio return, sector benchmark return. Okay, so generally you're just focusing on this component here for this kind of question. These are the attribution components, right? Okay, so compute number one, the pure sector allocation return for consumer non-durables. So this is here, this component here, all right? And we are considering the pure sector allocation. So when we talk about pure sector allocation, remember, we are focusing on the W component, right? BJ minus PJ, and that is then on the W component. So we are interested in this one here, right? The weights. So how do we calculate it? If you just flip to your next slide, see, we consider the W minus the so-called PJ minus BJ here, all right? And then we consider what? We need to consider also the return, right? Which is here. What is the sector benchmark return? And then what is the return on the total portfolio? Remember the portfolio return, the RB. So I'm just going to flip back to the formula here. The RB here, remember, RB, which is your portfolio return. So it's here, okay, total portfolio return. Any questions for this? Any doubts? How you calculate your pure sector allocation? We're okay. Okay, if we're all right, Then I'll go on to within sector allocation. So we remember within sector, we are looking at the R component, right? The R component where the PJ minus BJ. So and this one is for technology. So let's look at technology here. Okay, so we're looking at here now, this part, portfolio return minus the sector benchmark return. So this is what we're interested in, meaning what we're looking at this. Can you see here? That we actually found the 2% minus the negative 0.3%, which is your PJ minus BJ for your R component. All right, and then your W, remember, is fixed at the benchmark, if I'm not wrong, which is here, 16.02. Okay, so this is your thing. Okay, sorry, I kind of missed out what does this negative 0.04 means. So going back to your pure asset, pure sector allocation means that the decision to underweight. So how do you determine underweight? So this is, remember, your benchmark here, and this is what you allocated, right? And this is for your consumer non-durables. So you notice that you underweight compared to your benchmark. And because you underweight these consumer non-durables, this result in a negative return. So it basically means that underweighting the sector result in a negative performance or contribution to your portfolio return. So this is bad, right? You make a wrong decision, you negatively weigh it. Now, looking at this within sector, so within sector is about asset or not asset, security selection. So which stock you buy, whether you buy a Keppel or you buy ST Engineering, right? So let's say within the technology space, what happens is that you selected stocks that actually perform well. So you actually select right stocks, which is good. And this results in a positive contribution to your overall portfolio of 0.73. Sorry, 0.37. All right. Okay, last but not least, we'll look at the interaction term. And the interaction term now, what? We're looking at the asset allocation and selection interaction for technology. So again, we're going to look here. And remember, when we're talking about interaction, we are interested in the PJ minus BJ of both W and R, right? W and R, meaning that we're looking at the weight of the portfolio, weight of the sector, return of portfolio, return of the sector. So all these values here, right? And this shows you the interaction. So basically what happens is that, again, you underweigh the technology space. So this is a benchmark and you underweigh it because you only do 12%, you're supposed to do 16%. And then you maybe do some selection of your stocks, right? To select correct securities. However, this overall result in a negative contribution to your portfolio performance, which is negative 0.09 here. Okay, I'll just go and pause here. Any questions, any clarifications that you need for this question? Again, I'll repeat, this is very important. Anyone need me to repeat this example again, or we are good? We are good? Everyone's okay? Yeah. Okay, thanks for reply. Maybe the rest, maybe it's a Friday, I guess. Okay. All right, very good. Okay. All right. Okay, so that's all for attribution. All right, so we talk about a lot about attribution, right? Macro attribution, micro attribution, and I want to highlight micro attribution is the important one that we need to know how to calculate. Okay, we've talked a lot about it. Now let's go on to performance appraisal. Again, sometimes I feel it's a bit detach away from even like work or even like understanding this topic. Because now performance appraisal, usually, if you're a manager level, let's say you are the head of a department, this is where you implement this kind of performance measure, or you're the CEO, that's where you kind of implement this kind of performance measure, right? So for example, if you are in, like, let's say just mid-level kind of executive or mid-level management, you probably never use this kind of thing. So it might be a bit detached away from your understanding. But let's try to understand this performance appraisal process and how it can be done, right? Let's say in the future, if you are a manager, at least you know about these techniques. Okay. So we are again appraising the portfolio manager. So we need to consider various factors, right? Is the manager actually skillful in getting the results, in getting the returns, right? Or is it just luck? He just anyhow buy some stocks and then so happened that that year the market is doing well, right? Now, how much return is being generated from the risk taken, right? So now we're bringing back the idea of risk. So yes, you might generate a lot of return, but are you taking excessive amount of risk? So we need to be able to appraise the manager on that, right? Because should the manager be hired, return, retained, or fired? I guess this is the purpose of appraisal, right? So those of you who are working, you know that appraisal period, I guess it's already over. Now it's like the bonus period for those that are working now. So yeah, after your appraisal, then you get a bonus, right? So during your appraisal, your manager usually tell you, oh, are you doing well? Are you falling behind? And then they try to justify, right? So similarly for portfolio manager, they will be assessed, right? The portfolio manager will be assessed, and they are very quantitative assessment on portfolio manager, right? So the aim is to hire a manager that can do research and make sure that he produce return that exceed or in excess of the benchmark through various styles and health techniques. All right. So again, at the end of the day, as of every topic that we have mentioned so far, even rebalancing, right? We always mention about this idea of biases. And this happens simply because even for asset allocation, even IPS, market expectation, all these are all done by humans, right? All done by us. And as humans, we usually have our own biases, and this result in certain, bias in our appraisal as well. And many of y'all who are already working knows that, oh, my manager don't like me, always rate me badly. Yeah, so that is a very direct way of attributing bias, right? Someone don't like you, and therefore he rate you badly because too bad he's your manager. But in a more quantitative sense, there could be biases as well, right? In terms of evaluating the kind of risk and return, and the manager could, because of these biases, rate you bad. Of course, if the asset is the asset that is select, the kind of asset that the portfolio manager select is infrequently traded, this will result in what? In a standard deviation that has a downwards bias, meaning that because it's not traded so frequently, right? Meaning that the recorded kind of differences in the returns, remember standard deviation is the difference from its mean, right? The differences of the return wouldn't be so obvious, right? So there's a downward bias. So in a sense, this will impact the kind of performance appraisal, right? Again, we mentioned about options. So remember options, we have the payout profile in the last lecture. They have different kind of payout profile. They're not like stocks, they're not like forwards. And therefore, because of that, it may distort the kind of like performance appraisal. And why we are so interested in this idea of standard deviation, we'll see in just a few slides that at the end of the day, we want to divide the returns over the standard deviation or the beta. Meaning what? We're trying to find out what is the amount of return you get per unit of risk taken, right? And the risk can be total risk. Total risk is measured in standard deviation, or beta risk, or systematic risk, which is measured in beta. All right, that's why we are so interested in this standard deviation thing here. Last but not least, there's this thing called survival bias, which is a very interesting concept. Anyone heard of this thing called survival bias before? Yes? No? Roughly? Okay. Okay, so this is my ugly drawing of a plane. Okay, so this is a plane. Let me just try to explain this survival bias. It's quite interesting. Okay, some of your yes, no. Okay, yeah, so those who have heard of it probably already know this plane story, right? So this is a plane that goes to war. Yeah, correct. So only managers that do well survive, right? Yeah, correct. You never make it through the period. Correct. So yeah. Okay, for the benefit of those that have not heard before, so this is a plane that goes to war, and the plane basically comes back with bullet shots, right? So these are the bullet shots on the plane. Let's say there's two areas here, and then the engineers say, okay, you know what? Based on the bullet shots on all these planes that return from war, where should we protect the plane more? So question, should we protect the plane more in A, B, or C? So which part should we protect? So these are the planes that came back from the war, and all these are the bullet shots here, A and B, C, correct? Yeah. So I think everyone knows. So because the plane, only the planes that came back are shot A and B, meaning that A and B, if you're being shot at A and B, you can survive, right? Is the plane that being shot at C did not survive. That's why it did not come back from the war. So yeah, so survival bias, like what a few of your friends mentioned, only managers that do well will survive and be in that pool of, let's say, managers being assessed, right? And therefore, this will result in an upwards kind of bias on, first of all, the let's say the returns, or let's say if you're using, remember, the median manager kind of measure of performance, then that will kind of distort the measure, right? So this is a kind of bias that is very common, right? In the workplace, especially when doing appraisal. So this survival bias, something that usually it's very hard to remove from appraisal process, but it's a bias that is very, yeah, it's just very prevalent. Okay, so risk-adjusted performance measure, again, these are the ways to kind of measure or praise the manager. And there's a lot of measure, right? But let me just give you the broad intuition behind it. All the measures, what they're trying to do is very simple. They're just trying to do, take the returns divided by the risk. And they use different kind of risks. They use a lot of like different metrics and everything, right? But at the end of the day, what we're trying to do, we are trying to determine what is the return per unit risk taken by the manager, right? And which one is better? Should you get a higher return or lower return per unit risk? Higher or lower, which is better in terms of appraisal? Yeah, so that's right. Naturally, a higher return is better. So that means you're getting higher return for 1 unit of risk taken. So in all measures here, the higher the better. All right. So excess return, actual minus expected. Expected return. What's the expected return? Is the risk-free rate plus the risk premium. So something that we kind of already mentioned in the past. But at the end of the day, when you are praising someone, we want to see what is the return per unit risk. Okay, so let's look at individual methods. So we have 1, 2, 3, 4, 5. We have 5 methods here, right? Okay, so we have the this thing called the Jensen alpha. So remember when we are doing appraisal, this is very critical to understand, is that all our data is exposed. So this is very important. Okay, exposed, meaning that it has already happened. Remember that when we talk about all the market issues, right? We talk about modern portfolio theory, which we again talk about later in just a few slides. But we always talk about all the market kind of like CAPM model and all those. Those are all ex ante, meaning what? They are forward-looking. They are expected return, expected this, expected that, expected market return. So all those are expected because they are forward-looking. But when we're doing a performance appraisal, everything is exposed. So I want to highlight again, exposed is very important for you to understand why all these things are being placed in this way. Okay. Okay, so I hope this doesn't look too scary to you, because you know what? This actually looks quite like the CAPM model, if you notice, right? So what is happening here? So what is RAT, meaning the return on the portfolio minus the return on the market index, which is almost return on the market index. And remember, in your CAPM, this is your expected market returns, right? Your ERM. So in CAPM is your expected market returns, but in this case, this is your market index for that period, meaning it's exposed. All right. So as you probably notice in your CAPM already, you also just minus your risk-free return. So you minus it from both your from the portfolio or the account and the market. All right. And then you have the beta relative to the market index here. All right. And this epsilon, if you do remember your so-called O-levels kind of mathematics, this epsilon is just basically an error term, nothing to worry about. It only happens because you are doing a regression model. So basically, a Jensen alpha is a linear regression, and in all regression, we have to consider the unknown factor that is not captured in the regression, right? It can be other things. For example, this can be like the political situation, maybe, or the, let's say, the market sentiments, like, so things that are not captured in this regression here, right, will be captured in this error term. So don't worry about it. You can just kind of imagine that it's not there, right? Because it's just there because of the regression. And after having all these terms here, right? This, and this, what we do is we plot it on a regression. We plot this regression line, and then we basically determine what is your Jensen alpha. So we're actually searching for this Jensen alpha. And in most cases, right, we know what's alpha, right? Alpha is return that's beyond the market, right? So the baseline Jensen alpha is 0. So after we have all these variables, and we plot these variables here on the regression line, and we come up with this alpha term, we compare it. Is this alpha negative? Of course, negative is bad. Or is it positive, which means that you are doing better than the market? And of course, it's positive, that means your manager is doing well now. So this is one of the ways to appraise the manager. So your benchmark is 0. So 0 alpha means that you are just doing as good as the market. There's no special. You just get market returns, that's all. So that you don't get any alpha returns. Any questions for Jensen alpha? So again, if your finals ever do come out, they usually give you the values already, all right? And then they usually ask you to calculate your alpha term. And so the thing is, at the end of the question, usually ask you to comment, right, whether it's a good or bad. So we need to know that the benchmark for Jensen Alpha is 0. And we need to understand what is actually Jensen Alpha trying to say. It's trying to say that is your manager skill of managing the portfolio producing alpha returns for you. And whenever we talk about alpha returns, we're talking about things that is beyond the market returns, right? So anything beyond 0 is a good thing, right? So that's the purpose of a Jensen Alpha performance appraisal. Okay, so that's number 1. Next, we're looking at this thing called trainer ratio. So a trainer ratio, I would like to show the graph in the next slide. But what it shows is actually just the slope of the SML line. So again, I'm tapping onto your year 1 financial management course knowledge on what's this SML line. Basically, SML line is your line that creates or gives you your CAPM model. Okay, and what so special about this trainer ratio is that it focuses purely on systematic risk, meaning it divides. Can you see that RA minus RF? So RA is your return on your portfolio minus your risk-free return. Okay, so you're calculating how much this portfolio is generating in terms of return, less of your risk-free, right? So you ignore your risk-free. Your risk-free, everyone can get risk-free rate. Now, but then you only focus on systematic risk, so beta risk of your portfolio. So this is the important part. It's only systematic risk. All right. You're not considering total risk. Total risk we'll talk about it in a bit. Okay, so this is the trainer ratio. Usually, again, it's quite simple in the sense that they'll just give you the values, you just plug it in. But for your understanding, I'd like to bring back some, or hope that you can recall some knowledge on your SML line. So this slide, I want to repeat that it's not important in terms of your module. So this I actually extracted from your year 1 slide. It's just more for understanding, right? So rather than just memorizing, oh, trainer ratio is RA minus RF divided by beta A. That would serve you no good in the future because you probably forget it after the exam. So to understand it, I want to bring back the idea of this SML line, which is the security market line. And so security market line happens is where you have your beta of the asset, right? You remember, beta measures systematic risk. We know that the market beta is 1 here, okay? And we know that the beta of a risk-free asset is 0, right? Which is here, okay? And so with the market beta and risk-free beta, we can plot a line and we can determine what is the gradient of the line, right? So let's say I want to plot this line here, all right? And I'll determine what's the gradient. So the gradient of the line, basically what is Y, which is expected return on market, Y2 minus Y1, which is RF, right here, right? So Y values minus the 1 and is 0, right? 0. This would give me my gradient of the line, right? The gradient here, the gradient of this, the gradient of this line here, right? The gradient of this line here. So this is the gradient of the line. Can you see that the gradient of the line, it is very similar? Okay, I'm just going to go back 1 slide to your trainer ratio here. All right, expected return. This is your return on the assets here, right? And again, remember that your SML line is based on expected value, right? Ex ante value. So when we're doing appraisal, is ex post. So this clearly highlights the difference in ex post and ex ante. So because you're doing ex post, we no longer care about expected market returns. We don't care about this. We consider the RA here. All right. And of course, we know that we are not considering purely the market. We are considering the portfolio, right? The portfolio beta. And because of this, what happens here? This beta becomes the beta of the A, right? And with this, we basically get the trainer ratio. All right. Any questions for this? how we get the trainer ratio and the understanding of the trainer ratio. So maybe as you think about any questions, I just want to highlight to you that the trainer ratio gives the gradient of the line. And this means that if the gradient of the line is steeper, right? For example, steeper than your market line, means what? That you actually, it's quite good. That means for example, we're looking at this level of beta. So this, let's say uh, beta one here. For beta one, right, the market say that, oh, you know what, you're supposed to get this amount of return only. But based on your portfolio, hey, you're getting more than your market. Can you see that you're getting more? So a higher trainer ratio gives you a better, means that you're doing well. That means you're performing very well. All right. So this is trying to explain to you how a higher trainer ratio means a steeper line. A steeper line means a better performance, a better appraisal. All right. No questions on the trainer ratio? We're good. Okay, let's clear this. Okay, so before we move on to the Sharpe ratio, let's just again take a quick 7 minutes break. We'll come back in I guess 8:15. Yep. Yeah, so it's almost the same as Sharpe ratio. I'm just going to after the break, we'll talk about Sharpe ratio and how it is different. All right. Let's take a quick break, refresh yourself as usual, and then we'll be back in a bit. All right. All right, welcome back. Okay, so let's talk about the Sharpe ratio now. So if you notice, Sharpe ratio is very similar to your trader ratio. As one of your classmates pointed out, is it the same? The question is, the answer is actually no, it's not the same, simply because we are talking about total risk. All right. So notice that your trader ratio just talk about beta risk. Now your Sharpe ratio is measuring total risk, and when we think about total risk, we need to return back to the idea of your capital market line, right? Your CML. So the other one is your security market line. This is your CML, capital market line. And this is not something new. We saw this in your lecture 2, your capital market line. And so yeah, the only difference is that you're appraising your manager based on total risk taken, right? So let's look at your capital market line. So remember, your capital market line was your tangency portfolio, the line that touches your investment frontier. So you have, remember, all your assets, your minimum variance portfolio frontier. And if you notice here, the difference is that based on this idea of efficient portfolio, your capital market line, we use the standard deviation, because when we're measuring portfolio, it's no longer a single asset, right? When it's a single asset, we can measure it as a beta risk. But when we're measuring portfolio, basically what we're doing is we are using diversification to reduce your risk. Of course, we can't reduce all your risk, and so we need to measure it using standard deviation. All right, and so we have your capital market line here, and the concept, this time I will not draw it, I'll draw on this diagram, but the concept is exactly the same. The concept is that the steeper the line, meaning that maybe I'll just do a quick draw. Basically, the steeper the line, the steeper your Sharpe ratio, right, means that you're actually getting more returns for the same amount of standard deviation on total risk that you're taking, right? So this is the capital market line. So based on the capital market line, you're getting this, but based on the manager's Sharpe ratio, he's getting this, right? So it means that he's doing better than the market, the capital market line, right? So this is a good thing. So higher, the better. Okay. So very similar again. Again, both the Sharpe ratio and trader ratio is measuring what? Return per unit risk taken. Okay. All right. So hope there's no questions on this Sharpe ratio. It's very commonly used. Usually people prefer using the total returns, right? Because we're talking about measure the returns over the total risk, because we are talking about portfolio. So Sharpe ratio is more commonly used. Next, we'll talk about this thing called information ratio. And if you notice straight away, right, before even reading all these paragraph explaining to you the ratio, this is very similar, right? Can you see immediately that it's very similar to your Sharpe ratio? And the only difference here is that we are replacing the risk-free rate with the benchmark. So actually, at the end of the day, right, all these formulas are just like derivations of each other, almost. You can think of it this way, right? You just remember one ratio, and you just kind of understand the intuition behind the ratio, and therefore you can kind of derive the ratio. So the information ratio basically tries to show that, you know what, how much of the portfolio return is above the benchmark here. Okay, and because we're comparing the benchmark, we now need to consider the difference in standard deviation between the return on the portfolio and the benchmark. Remember why we didn't need to consider previously? Because we are considering against, I'm just going to flip back, against the risk-free rate. And the risk-free rate for total returns and systematic returns is 0. So we didn't need to consider it at all, because it's 0. Even though based on the equation of gradient, we have to minus the 0, but basically just disappears, right? It's not part of the thing. So for information ratio, because we are comparing against the benchmark, we need to consider the difference in standard deviation of the between the portfolio and the benchmark. Okay, that's the only difference for the bottom, the denominator. Okay, so basically it measures the amount of rewards earned by the manager per unit risk created by deviating from the benchmark. So that we're not comparing with the risk-free rate, that we're comparing from the benchmark. Okay. Okay, so that was information ratio. Now, your M square. Okay, so this looks a bit like, oh, now it looks a bit more scary, but can you immediately see again that it looks like your, especially this component here, it looks like your CAPM model, right? Remember, risk-free rate plus something. Then remember for CAPM, we had a beta here, but now we have the standard deviation of the market index. And then this is, remember your CAPM, this was your beta, right? When we think about, actually not this, not beta, sorry, this for CAPM it was 1, right? 1 minus 0. But now you're thinking about it in terms of the portfolio. So you have the total risk of the portfolio here. So what's this M square measuring? Basically, the M square, we're calculating this value here, M square, will take into account what is the return if it's taken, we consider both the total risk as the market, as compared to the market index. That's why we have this index here. So the return includes, first of all, the risk-free rate, and then the portfolio kind of return that you get, right? Based on the index, market index here. Okay, so of course, M square, again, as the last few ratios, the higher, the better, right? A skillful manager would generate M square that exceeds the market index. So if you notice that actually this is your Sharpe ratio. So that, again, I mentioned they're all derivatives of each other. So this is a Sharpe ratio here. All right, and this looks a bit like your CAPM model. Any questions regarding the M square? No? Okay. All right, so that's all for appraisal. So so again, repeat the appraisal. We have learned a few methods on appraising the manager, and they are all simply based on the idea of return per unit risk taken. All right. Now let's just move on to this part called GIPS, which is Global Investment Performance Standard. I want to repeat again that in this slide, this portion of the discussion, whatever that's covered in the slides is sufficient. Even though if you refer to your study guide, they have like, I think, many pages on GIPS, right? And it can go very in-depth. And if you do take a CFA level 3, you have to study in-depth, of course. But for the purpose of this course, we just need to just understand what is this GIPS. It's not something that if somebody say, oh, does your portfolio follow the GIPS? So at least you know, oh, what's GIPS, all right? And just to give you an introduction. If you want to read more, simply refer to your study guide. But it's not necessary for this course. So the GIPS is basically this kind of performance standard that's been standardized by CFA. It kind of has the standard, includes standards not only on like return performances, which is part of it, but it includes, you know, things like ethical standards, kind of like data representation, you know, promoting fair competition between firms, etc. Right? So it is more than just evaluating performance of the portfolio. These are just some benefits. I will just leave it for you to read through. I won't really go in detail. Like I mentioned, there's like ethics, transparency. They have some best practices, and a lot of actually organizations sign on to these GIPs. Organization meaning asset managers. They actually follow these GIPs. And so, if you're ever wanting to go to the asset management field, usually they'll prefer you to have a CFA certification, right? So there's some self-regulation, internal controls, etc. So again, this one, I'll just let you all to read through. It's just some stats on GIPS. Basically, is what I'm trying to say is just a more composite measure. They talk about risk, objective, ethics, returns, and things are quite subjective, right? So it's not just, what is your value dollar return, or what's your monetary dollar return for your portfolio. And that's not all we look at, right? We look at various concepts such as, are you meeting your objective of your IPS? Are you meeting the client's requirement, etc.? All right, so this is the composite hierarchy as proposed in GIPS, where we actually have to look at all these details. What's your mandate? What's the asset class? What's your strategy? What's the benchmark? Risk and return. So a lot of them are quite repetitive. You notice like in IPS also required to do that. And so in terms of your performance evaluation, you kind of have to do the same thing, right? You are now just evaluating your managers based on all these matrices. All right. Again, this is to explain to you that, when we are doing portfolio management, because now we are in the concluding remarks of portfolio management, because remember, next lecture, we're just talking about ESG, right? And ESG, yes, is part of portfolio management, but it's already separated. It's a separate topic by itself. So this is already concluding the entire portfolio management process that we have looked at for the last now 5 weeks already. And so, at the end of the day, as a portfolio manager, what's important is, first of all, good ethics, a good business, because so ethics is very important as a portfolio manager. But not only that, but we have to gain the trust of the client. So remember, the client might be giving you a lot of money, right? Might be investing, putting like his life savings into, let's say, to you, right, to give you the money to invest. And so we need to win the trust of your client. And a lot of the times, trust is based on networking, it's based on human soft skills aspect. So what I'm trying to say at the end of the day is that, yes, you might have taken this course, but or taken a lot of other courses in very technical finance kind of module. But when we go into the job market, a lot of times, and perhaps you already heard of this, that networking is very important, right? Like perhaps a lot of other professors, or even maybe your boss, if you're working now, tells you that, okay, networking is actually more important than perhaps even hard knowledge that you have acquired in university or beyond. So the same thing as trust, right? How you gain trust is through networking, is through building reputation, good ethics, and of course, whether people know you, that you exist in the industry. All right. So because of that, CFA kind of places a very strong emphasis on code of conduct, on ethics. All right. So in the last slide, so all these slides not so important. You can just read through, skim through. At the end of the day, the loss of trust is a big issue in the financial market. We have a lot of scandals. We have a lot of financial crises. The Lehman Brothers, 2008, etc. And because of that, there's also loss of trust in bankers, in portfolio managers, and so at the end of the day, we have to try to gain back the trust of the client, right? And so the last but not least, so how should we work with our client? So this is just a very general, broad-based kind of approach again to remind you that, as a portfolio manager, you want to, first of all, together with your client, identify your goals. You create your IPS, your plan, right? Remember, your goals is based on your various factors that you mentioned, your uniqueness, risk, appetite, etc. Then you create your IPS plan, right? Once you create your IPS plan, then execute your IPS plan, right? Do the asset allocation, and of course, make sure that you have done your proper market research. Make sure that you have done all the industry, inflation, etc. analysis. Create your portfolio, and then once you create a portfolio, make sure that you do rebalancing, stay on course, and at the end of the day, you'll be evaluated as a portfolio manager based on the things that we talk about: attribution, we talk about appraisal, right? And then there are different, right? Attribution, macro and micro attribution, and then we appraisal and all the different methods of appraising the managers based on the return and risk. All right, so actually that's all I have for you this lecture. And basically it concludes the entire portfolio management process from start to end. And yeah, any questions for the entire lecture so far? Just want to highlight that next lecture we're talking about ESG. It'll be a very light lecture, and then we will go through the GBA. Hopefully you have some questions regarding, if you have questions regarding the topic so far, happy to address any questions, because we will most likely have extra time as well, like today. Okay, any questions for this lecture or previous lectures? Yeah, I'll just wait for a bit. Comments, questions, feel free to chat or type it out before we conclude for the day. Okay, let me just pause the recording.